Hello and welcome to another insightful edition of Investment Acorns. This is our exclusive series featuring thought leadership from fund managers at White Oak Capital Asset Management Limited. Joining me today is Manuj Jain. He's co-head product and strategies at White Oak Capital AMC. Welcome, Manuj.
Thank you so much.
Manuj has written this thought-provoking column in Wealth Insight September issue called Winners Rotate. Manuj, let's start with what do you think? Why do you think it's risky for investors to stick to one particular strategy or style, even if it's performing well?
This is another interesting topic, and we try to explain this concept with the help of some data also. Let's take an example of an index which represents broader market, BSE 500. Okay. Now, BSE 500 covers almost 90% or more the entire stock market of India in terms of market capitalization. So, if we divide BSE 500 in various factors, so one factor can be growth style versus value style. So, there are few stocks you can categorize them value stock. There are few stocks you can categorize them growth stock because they are growing at a much faster pace. So, in BSE 500, the weightages of these two styles is almost 50-50%, 49% value, 51% growth, more broadly 50-50%. Likewise, another factor can be PSU company or non-PSU company. So right now, almost 13% of the BSE 500 index has PSU weightage. Another factor can be large cap versus small and mid cap put together. So about 73% is large cap at this point of time, or about 27% is small and mid cap. There can be another factors as export-oriented businesses, domestic-oriented businesses, race-sensitive businesses, and non-race-sensitive businesses. So these are all factors. Now, if you bet on one particular factor, now how you can bet on one particular factor? Let's say you are a fund manager, and your mandate is to create a flexi-cap portfolio diversified across sectors. But you have a natural tilt that I am a value investor, and I will invest more of my money in value-oriented stocks. So let's say index has only 50% stocks categorized as value, but you invest 90% of your assets in value stocks. So what will happen? There will be years which is very favorable for value stocks, and there will be years which are against not so favorable. So like 2018, 19, 20. If you look at these 3 years, these 3 years were very unfavorable for value investing. If you draw a chart of annual return of various styles, value was at the bottom, 2018, 19, 20 for 3 consecutive years. But if you look at last 3 years, like 2021, 2023, 2023, in fact, partly 2024 also, a calendar year till date, value is at the top. Likewise, PSU, for many years, PSU were underperforming, you know that. For many years, they were underperforming and everybody just gave up on them that they are just doing charity work and they will never make money. But for last 3 years, they are at the top. The same thing can be seen from the context of large cap versus small and mid cap. During 2018 calendar year and 19 calendar year, small cap was at the bottom. Large caps were doing very well. But right now, for last 2-3 years, small caps. So if you bet on one particular factor, you will be either at the top or at the bottom. So your performance, now how you measure performance, let's say in the context of mutual fund, typically you compare with benchmark. So if we are talking about a flexi cap fund, the benchmark is BSE 500 TRI. So because your BSE 500 has a 50-50% weightage to these two factors, value versus growth, but you have 80-90% allocation to value. In 2018, 19, 20, you will be at the bottom in terms of performance. Your underperformance as compared to benchmark will be very high. But in last 3 years, you will be at the top. So the volatility of alpha will be very significant. The performance volatility in terms of whether you are in top 1 quartile or bottom quartile will be very high when you bet on one particular factor, because these factors are influenced by macros. And macros are beyond us. We can at best try to figure it out what will be their impact, but there will be something happening somewhere in the world. Like recently it was geopolitical tension between Russia and Ukraine. They have impacted differently to different segment of the market. For defense, they were like very good. It was a very favorable outcome. But for many other businesses, it may not be. So to sum up to your question, that yes, winners rotate because of some external events which are beyond our control. Index let's say we are talking about BSE 500, is an amalgamation of various factors. As a fund manager who is managing a flexi cap fund diversified across sectors, you can try to marry those factors in line with the index, or you can divert your portfolio in particular for particular factor. That my style is that I will only invest in small and mid cap because I'm very good at it. My style is that I am very good in picking value stock. My style is that I am very bullish on PSU. These extreme can maybe over the long period of time they can generate decent return, but intermittently it can give a very volatile investing experience.
Right. Now, you also touched upon the concepts of active share and active risk in your column. So, could you break these down? Explain how everyday investors can use these metrics to build more resilient portfolios.
Sure. So, see, when people invest in, let's say, active mutual funds, let's say we are talking about flexi cap category. So, your expectation is that, okay, BSE 500 is delivering, let's say, X percentage return, let's say 10% return. So, because I'm giving this money to some professional fund manager, they should generate, let's say, 1% or 2% higher return than the benchmark. Okay. So to beat the benchmark, first of all, you have to create a portfolio which is slightly different than the benchmark. If you buy all those 500 stock in same proportion, you cannot beat the benchmark. You will underperform the benchmark because there are charges and transaction charges, etc. So you have to create a portfolio which is slightly different than the benchmark. So to what extent your portfolio is different from the benchmark is called active share. So active share is basically how much of your portfolio by weightages is different from the benchmark.
So let's active management, you're saying?
Yeah, active management. So it is a measure, active share percentage. It is a percentage number. Let's say it can be 60%. So if we say that this particular scheme or this particular flexi cap mutual fund scheme has a 60% active share, it means 60% of the portfolio composition is different from the benchmark. Now, it is important because only then potentially you can generate alpha, because you are buying a portion of the market which is not present in the benchmark, but you believe should do better than the benchmark, or maybe you are avoiding certain stocks which are part of the benchmark but not part of your portfolio, hopefully with a belief that these stocks will underperform the benchmark and hence they are not part of my portfolio, so I will be able to outperform. So first of all, active share is very important. Without this, you cannot even potentially generate alpha. Forget about generating alpha, you cannot generate alpha without active share. Now, second is that just to have active share, you should not build active share. Just to show that my portfolio is different from the benchmark. There should be solid reasoning that these are the stocks I like and this is the fundamental reason, and that's why I believe that these stocks should do well. There are few stocks which are part of the benchmark which should be your portfolio as well, because these are very good stocks and they should do well. Just because they are part of the benchmark, I will not buy it. That should not be the idea. Now, if you build too much active share, now this is important thing, that active share can be built by two ways. First of all, you bet on particular factor, like we discussed. That benchmark has 50% value stock. I buy all those value stock, but let's say I allocate 100% of my portfolio in those 50 stocks. So again, you will build up active share because your portfolio will look different than the benchmark. But now your portfolio is exposed to a factor risk. The factor name is value. So your portfolio is exposed to value factor risk. So in years when value will do well, your portfolio will outshine everybody else, or vice versa. So this is one way of generating active share. So you want to generate active share, this is one way of. Second way of generating active share, which we believe is an ideal way, is that let's say benchmark has 50% value stock, 50% growth stock. You also keep around 50% value, 50% growth, but within value stock, which stock I want to buy? And within growth stock, which stock we want to buy or avoid. So this is called bottom-up stock picking. Now the benefit of generating active share by this second approach is that you are neutralizing any factor risk which can impact your portfolio, and within those factor itself, you are buying stocks which you believe, based on your research, are fundamentally good company. So by creating this portfolio which is factor diversified, you can achieve active share but without increasing active risk. So what is active risk? So let me just explain this also. So active risk is basically all this thing we are doing to generate alpha. Let's say potentially there is a 2% alpha. But when you generate active share by betting on one particular factor, your alpha volatility increases, because there will be some years your alpha will be, let's say, 10%. There will be few years your alpha will be, let's say, minus 8%. On an average, it will be 2%. So active risk measures the alpha volatility. If the alpha volatility is too high, so your active share will look very high. Whereas in second approach, if you build active share by neutralizing, to some extent diversifying across various sectors and only focusing on stock picking, you can achieve active share by keeping active risk low, which means your alpha volatility will be low. So ideally, an investor should try, I mean, this is more for the fund managers to manage it, but fund managers, the ideal situation is that if I can achieve a desired level of active share, let's say 60% active share without increasing active risk. This is the ideal situation, that without increasing alpha volatility, I am potentially will be able to add alpha.
Okay. Now, you mentioned factor diversified portfolios. You also mentioned this term factor diversified balanced portfolio, which might sound confusing to some investors. Can you explain what is it and how it helps investors to avoid dramatic ups and downs in their portfolio?
So for example, let's take current situation. Today, there are too much discussion about PSUs doing well. They are doing really well. Government has increased capex, etc. But index has only 13% weightage in PSU. So right now, if you invest, let's say 30, 40, 50% of your portfolio in PSU, or let's say in direct play of PSU, let's say today, defense is another segment which is hot today. So you are diverting your portfolio as an investor at an investor level. If most of the funds you have picked in the mutual fund basket are PSU oriented, value oriented, okay, or let's say particular theme oriented, defense or manufacturing. So you don't even realize, but you are tilting your portfolio towards one factor. You are not balancing out, because index has only 13% PSU. But you have, let's say, 30, 40, 50% PSU depending on direct or indirect exposure. So the way we want to build a portfolio, or we are suggesting investors to build their portfolio, is that don't take too much diversion in terms of betting on one particular factor. If you do that, your performance will be very volatile on a year by year basis, and there can be prolonged period of underperformance. For example, I gave you this example of 18, 19, 20. For 3 years, value philosophy underperformed. Prior to that, almost for 6 years, PSUs have underperformed before they come back in 21, 22, 23. So will you be comfortable that your portfolio is underperforming for 6 straight years? I don't think people will be comfortable. And in that situation, what happens, because you have taken very skewed bet on one particular factor, and that particular factor is underperforming for 3, 4, 5 years, you tend to give up on that factor. But winners rotate. That factor will work someday. But a 3-year, 5-year is a long period, gestation period for somebody to hold on that portfolio, and they end up doing mistake. Most of us, including us, most of us, we all are human. We end up giving on that factor, and we end up changing that factor at the very wrong time. So to sum up, what do we mean by balancing out these factors is that consciously investors should make an effort that they should either invest in a portfolio, flexi-cap portfolio, which is diversified in all these factors, or if they are investing in various schemes, they pick and choose fund houses or fund managers with different style. There are fund managers who are very bullish, or let's say they are very overweight on value factor. There are fund houses or fund managers, they are very overweight on growth factors. You can have small cap schemes in your portfolio, large cap schemes in your portfolio, export oriented funds in your portfolio, defense oriented. So there should be a combination of various factors so that no one factor will determine your performance in that particular calendar year.
All right. Now moving on, many investors, they tend to heavily lean towards one style of investing, either value or growth. So what are some of the dangers of, focusing too much on one style, and how can that impact the overall portfolio?
The biggest risk is that there can be prolonged cycles of underperformance for any particular factor. Like you gave example of value versus growth. There can be, historically also, there was a period for 3 years when value has underperformed and now it is outperforming. There was a period when growth did very well, but now it is underperforming. So the biggest risk is that when a particular factor does very well for, let's say, 2-3 years, most of us start to believe that this is the only thing which will work over the time, and we tend to allocate more towards those strategy, which can be detrimental, because as I said, winners rotate. That is the adding of a column also. So these things keep on rotating. Something which has worked well in the past may or may not, most likely it may not work very well. So the biggest risk is that the prolonged cycle of underperformance led to investor taking wrong decision at the very wrong time, because more often people tend to give up on one particular strategy at the bottom of the strategy, which is the worst thing to do.
Right.
So there will be years you will see your strategy doing phenomenally well, but there will be year you will see your neighbors getting rich, but you are at the you at the margin of your strategy, you are not doing so well. So again, that leads to revenge buying. You tend to buy things which have done very well, believing that your strategy is poor, and that is exactly, you should not be doing it.
Now, for those who want to invest more strategically, how can they strike a balance between different strategies or factors to achieve more consistent results?
I think for that, you need to read more about a fund house strategy, their philosophy, and more specifically the fund manager with whom you are investing. Various fund managers have their own style investing, nothing bad about it, but over the years they have developed a style of their own. So if you're investing with a fund manager who is, let's say, very, very value tilted, I think it makes a lot of sense that you pick another good fund manager which is very, very growth tilted. Or else you pick a fund manager or fund house where they have openly communicated that our strategy or our philosophy is that we don't bet on one particular factor, and we try to make a factor diversified portfolio, so that you don't have to worry about that this is a growth style of fund manager and this is a value style of fund manager. You give that money to, let's say, we try to communicate to our investor that we try to create a very factor diversified portfolio, and within those factors we only focus on bottom up stock picking for potentially generating alpha. So these are the two ways. Either you pick a fund house which is factor diversified in their philosophy, or you pick 2 or 3 fund house with different style of management. Hopefully all these 3 are good, so you will be able to create a factor diversified portfolio.
All right, with that, we've reached the end of this conversation. Thank you, Manuj, for taking the time for this conversation. It was great having you.
Thank you so much, Archita.
Thanks.